the gold miners are vastly underperformed, and therefore they're a potential major long-term investment buy. However, we're at a point now where if you join uranium now, I think you're doing an NVDA-type trade. I think the gold miners are likely to bottom this time in the same manner that TLT bottomed last October. Namely, they look like utter hell, and then suddenly they're out of the hole. We've got to remember, if you're a major portfolio manager, you don't go out and buy junior miners. And if you're looking at platinum, don't try to confuse it with gold. So I could see a huge percent upturn in lithium and the miners, but I'm suspicious that the upturn won't get you back to the highs we saw, a couple of years ago. I still think the threat is that as a crisis develops, and I think we're headed for an economic, political, monetary crisis of proportions we've not seen.
All right, Michael, last time you and I spoke, you promised me $8,000 gold, and it's, what has it been, 3 months later, and it hasn't happened yet. And now I'm kind of mad at you. So I'll leave it to you to start the podcast.
Okay. The talk about the actually more like, $8,000 gold was that its bear low was in late 2015, December, 1,050. It's called $1,000. Okay. And right now we've doubled, and we've been sitting here for 3 years plus. Okay. 3.5 years, just sitting there. We've had some sharp pullbacks that cleansed the gold market. You took out some lows that scared everybody, the 1613 low, October 2022. And suddenly we're back to the highs. And they keep selling it, selling it, selling it. If you look at the gold price chart, I mean, it's never, ever topped this way. In fact, we argued that a couple of years ago when it had already hit 2050 back in the summer of 2020, that you don't top by coming back to the high again like we did in March 2022. You go back to any gold peak, they're isolated. They make a high, they collapse, and they try to have a rally, but they never get back to the high, and then they have a bear trend, like in 2011. But if you go back and look at the 50 years of gold history, 1970s through the present, there have been two massive bull markets, at least. We were in the mid-$30 range in the mid-1970s. And by 1980, 10 years later, actually less than 10 years, it was $850. That's, many multiples more than 8 even, Okay. Yeah, there was a pullback in 1976. It was a correction, but, it lasted a year or so. And the next thing you know, you're off again. Okay. Then the next bull move came from a low that was around $255 in year 2000. Based there for a long time and turned up. And within 10 years from the emergent breakout, it got up to 1900. So, another 2000 to 1900. You do the math, the multiples. And remember that back then, we didn't have the monetary situation, the potentials that we've got now, the dynamics in other markets, potential political turbulence, for example, which is growing around the world, not just here, but, people, it's not booked into the markets yet. Anyway. So I think you can argue the fundamentals are different this time. They're far more serious, pending and developing. So it's no mystical thing to claim that, hey, gold could have another eightfold move. If it did, it may take it 10 years or so. It was 2015. Maybe by 2025, we'll be at 8,000. But that'll merely be replicating the multiples that we had in the couple of prior bull markets in the last 50 years. So it's not outlandish. It's merely a statement of, let's do the norm again. Okay. And also during those times, silver went berserk, as we all know. And quite often during those bull trends, if you go back and look at the price data, the bull trend in silver would follow gold up, but sometimes it would lag, sometimes it would outperform, but it was a lazy follower. Okay. And it would quite often underperform gold. But in that last year of those bull trends, such as 1979 to 1980, for example, or take 2010 to 2011, those years, look what silver did. It went berserk. It was in the tail end of those multi-year bull trends that silver locked and loaded and beat gold handily. So much so it was awesome. Okay. Well, we all know silver's underperformed gold for the last 3 years or so. Vastly outperformed it in that summer 2020 surge. We went from the upper teens in silver, and we went to $30, almost doubled. Okay, while gold went up from 1,400 to 2,000. So the multiples were far more in silver's favor. But in the last 3.5 years, it's lagged. It's bored everybody to death. They pulled their hair out, and especially the gold miners have lagged. In fact, they behaved almost like they're not gold miners. So we think that in the final phase of the gold bull trend, which began again in late 2015, we got bullish in February 2016, and nothing has changed our mind about the annual momentum trend of gold.
Right.
Yes, it's paused and corrected, but nothing's changed our mind. So nothing has derailed our analysis in terms of there's more to come. And I think that probably the miners in silver will outpace gold in the tail end of the bull market, which I think is probably going to become more and more evident as this year unfolds.
But over the last, 3 months or so since we last spoke, gold has been staying in a very frustrating range, if you will. What are momentum indicators, the ROC? What are they telling you about when and where it might break out here?
We've argued, especially since mid-December, that when the Fed came out with their minutes, it was December 13th, and basically announced in their own timid way that they weren't going to raise rates anymore. And the only question was, when would they cut rates? And then the debate is no longer whether they're going to raise rates. The debate among analysts was, when are they going to cut? Originally, they thought June, then they moved it up to March, and analysts thought, oh boy, it'll be March, they're going to cut rates. Well, now, that's been pushed off. We're now thinking June, July again. Okay, so, but at that point in time, if you circled the S&P 500 price chart or NASDAQ 100, it's gone up strong, okay? What's happened to, for example, treasury bonds, which have gone inverse now to the stock market? They were at a rally high, and they've done nothing since December but pull back. Not collapse, but pull back. We think it's a benign correction after a huge surge from last October's lows. What has gold done? Well, it had a brief peak running buy stops in early December where it hit 2100. No doubt there were buy stops there because it was all-time new high. And so you gushed up to 2150 in a matter of about 30, 40 minutes. It was in the dark. And then you collapsed back down. And since then, you've been mostly below 2100 and mostly above 2000. You had a few brief pokes down in the high 1900s. But gold has pulled back during that time. So gold and T-bonds, which are now somewhat linked, technically speaking, talking price of T-bonds, not yields, are inverse to the stock market. So we suggest to people who are looking at gold, you better watch the stock market. Now, we think the stock market is highly likely to be in a topping phase here of this recent surge. And the evidence should show itself as we move into March. If it starts to show itself, we're starting to also see, well, today's a good example. Golds move up, stock markets start to get wobbly, getting sold off its highs. But we're looking for evidence, especially in the next week or two, as we get into March, of downside breakage in the stock market that would indicate the onset of a pullback. Frankly, we think a pullback is unacceptable because there's certain technicals below the stock market that if you engage them, you're not just pulling back, you're topping. Okay. Now, at the same time, watch to see if gold firms. And I suspect that's what you're going to see. So again, look at T-bonds and gold somewhat paired in terms of their technical behavior last year or so, and watch the stock market, U.S. stock market. We think you'll find it to be an inverse situation. And likely that gold is watching the stock market. Why? Because the stock market usually will lead data points. If you go back and look at the history of stock market tops, and you're looking for the data points that will cause the Fed to panic, well, there are already some underneath the surface that they don't want to talk about, namely the bond market crash they had last summer and fall. That was a crash, and that upset the hell out of them. You can bet. But the normal, quote, data points that everybody likes to debate and talk about, they'll start to follow if the stock market rolls over. That's usually the relationship. So if that stock market rolls over, that is going to help spark some of the data points that the Fed will then be able to pivot on. And I think gold knows this. Remember, gold is a monetary metal. So when there's shifts in monetary policy, especially toward back what they normally do, inflate, that's what drives gold. So I think that's what we're looking at.
Why I ask that is because I wanted to follow up on what you said previously, that gold is still outperforming silver, right? It's again, you look at the 3 year, you look at the year, you look at the quarter, you look at the month, gold's up and silver basically, despite that interesting spike in silver at the beginning of December, I believe, when one of them so it spiked really is what you can call it. But so when one of them moves, you'd expect the other to follow, but it's been a long time since they could agree on something. Well, not to mention, by extension, their equity counterparts also don't tend to agree on.
Yeah, especially the miners. Yeah,
exactly. So how do you translate that move, the move in gold, into what silver is doing or might be doing going forward here?
Well, we're technicians. Now, we don't look at price so much. That's secondary to us. Everybody sees price and everybody sees the same thing. You know, if it's bleeding obvious, then it's probably wrong. Okay. We measure momentum of price on various timescales. Very long term, like annual momentum, you measure price in relation to a 3-year average, for example. Not just by overlaying a moving average on a price chart. Any idiot can do that, but measuring oscillating price in relation to the average. So you get a different visual picture on momentum when you create a momentum oscillator than you do when you look at a price chart quite often. Sometimes they're in sync, but oftentimes when a trend is about to shift, for instance, we've been under pressure since, let's say, mid-December in the metals. And in the case of gold, it's sort of been range bound. In the case of silver, well, actually, it's been range bound too, if you look at it, because we had a drop in, I think it was late December in silver that got us well down into the 22s. Well, where are we now? We're just below, we're trading the new active contracts. May silver's trading around $23. So yeah, it's more off of its recent high on a percent basis than gold is, but it's still in the range, so to speak, that it's been in since the December high and the late December low, if you go look at a price chart. Now, the miners are different. They have really been bleeding severely, especially in the last few months. It's almost like, the thought that crossed our mind is that back in summer of last year, T-bonds were starting to roll over, so was gold. Okay. And remember, gold went down from March of 2023 through October 2023. But it was not a huge pullback. It was a small double-digit pullback. Case of T-bonds, it was a puke. We called it a nuke event. We predicted in August there would be a nuclear downside event in T-bonds. And there was. It was almost a crash type dimension for T-bonds. And this, no doubt, scared the utter, out of the Federal Reserve, even though they can't admit it publicly, because then they would admit they're scared, et cetera, et cetera. But when that T-bond market, the U.S. long-term debt market, collapses and yields exploded to a new high above where they were in, for instance, October of 2022, that upsets the Fed because it's beyond their control. But we also thought that when that nuke event occurred, there would likely be a V bottom in T-bonds. And if you look at a price chart on TLT or T-bonds, it was a V bottom. They exploded out of the hole. So what was garbage one week suddenly was gold. The next week, they exploded percent-wise. You took TLT, for example, from a price of 82 up to 100. And you did it in a matter of 8-10 weeks. Okay. Since then, they pulled back, coincident with gold. I think the gold miners are likely to bottom this time in the same manner that TLT bottomed last October. Namely, they look like utter hell, and then suddenly they're out of the hole. I think one of the factors that might cause that is if you start to get a wobble in the stock market. So people who think that gold miners have to go with the stock market, lay the charts in front of yourself. Go back to December. They're total opposites. Total opposites. Gold miners have been going down, stock market up. In fact, gold miners have been going down precipitously last several weeks. I bet if the stock market shows a wobble, you're going to get a V bottom effect out of the gold miners, in which case what we measure is the spread relationship between the gold miners like GDX, for example, and gold. So we plot that relationship technically, and of course it's been in a downtrend, but it has certain dynamics that if it doesn't take too much of an uptick in the relative performance of miners, a regain in the spread relationship, to break certain momentum dynamics out that tell us that not only are the miners turning up a bit versus gold, but they're going to turn up a lot versus gold. And we're not at that point, obviously. We're more at the V bottom level. But I'm suspecting that when the miners turn, it won't be slow and gradual. It'll be a bolt of metal. And yeah,
I'm
go
sorry for
ahead.
interrupting, but you say we're not at that point. Do you know what that
We
point?
could be days away. We could be at it right now. In fact, I've got to see near-term evidence. Right now, for example, we have run in the last 2 weekend reports weekly momentum of 5 silver miners. We picked randomly, by the way. A lot of them are big names, but we didn't look at them and make sure they look like the other, because they don't. When you look at the price charts, they don't. 5 of the big silver miners and 2 of the big golds, Barrick and Newmont. And when you run a weekly momentum chart, and what do I mean? What's weekly momentum? We plot each day's range, price range, in its relationship to a 3-week moving average. So it's fairly short term. But when you look at the oscillators, not the price charts of all these miners, the 5 silver and the 2 big golds, you look at the momentum charts, they look like they're brothers and sisters. There's almost no difference in them. And they all have structures such that if you uptick most of these miners, some of them 10, 20 cents because they're trading at $2 and $3, or like Newmont and Barrick, you uptick them several dollars, they're going to blow through these structures. You don't see it on a price chart, but you see it on momentum, in which case we're going to say at that point, probably the V bottom is engaging, meaning you're going to see a resurrection from the miners. Why would it be a void on the upside? Probably because, one, they're so vastly undervalued now, probably more than they ever have been in history, even at the 2015 low compared to gold. They're probably worse now than they were then. And so in relation to gold, they're vastly undervalued historically. And in relation to the stock market, they're vastly undervalued in relation to other stocks. So we have a market here that, one, you have to make a decision as an investor. Is it really going to zero? Some sectors can go to zero in the stock market because they make a product that's been outdated. Technology changes. Okay, they make horseshoes and then we have cars. Okay, but gold miners, they're gold. Okay, and unless you think gold's going out of business, the gold miners are vastly underperformed, and therefore they're a potential major long-term investment buy from the old norms that used to prevail before people chased ballistic upside moves in stocks like NVIDIA, where investors would see an opportunity that is so underpriced that they're willing to sit there and buy it and wait.
Well,
Knowing it's not going to zero.
some days, though, when I look at my portfolio, it definitely feels like they are going to zero.
I know.
But you're right. What is that level in terms of, specifically in terms of numbers? Because you say basically so the stars have to align. One of the stars, the stock market and gold, but then silver to move. What is that level in the S&P? Where do you think that happens?
S&P can't afford to back off. I'll just throw you a couple percentage points. We get very specific in our report. You can't drop a couple percent. You literally drop a couple percent from where you are right now, and you're going to start to break momentum structures of various timescales. Now, what do I mean by that? If you're a short-term trader, you don't care what the big trend is. You care what's going to happen the next 3, 4, 5 days, right? Okay. So you look at very short-term metrics, daily price, hourly price, momentum charts that reflect that. Well, we're looking at bigger things than that, like monthly momentum of the S&P, where you measure, let's say, its price in relationship to a 3-month moving average, or 65-day average, which is popular in the Wall Street Journal. They often plot price, they overlay a moving average called a 65-day, which is what? It's similar to a 3-month, okay? So they only overlay the momentum. They don't do a momentum chart. They overlay a moving average. What we do is we oscillate the price in relation to that average, and we get a different visual picture. And what we see on the S&P right now is the December oscillator low, the January oscillator low, and the February oscillator low. Though in price they're higher, momentum they're flat. In other words, momentum built a floor that you could take a crayon and draw it if you looked at the momentum chart. You're going to break that floor if you drop about 1.5% to 2%, in which case you're going to drop more, a lot more than a couple percent. There's a problem when we go to longer term momentum studies, like quarterly momentum, where we measure price in its relation to a 3/4 moving average, like a 200-day average. It's fairly long term. We also have structures that you can't see when you look at the price chart, but you look at momentum and you say, good grief, if that were a price chart, I'd be scared. And there's an annual momentum number, and I'll give you the number. It's good all year. 4303 S&P. Okay, you say, well, that's 700 points below you. Well, what's that? That's a double-digit percent drop, 15, 20% drop. I'm going to start to blow annual momentum through a triple bottom. Meaning what? If you go back and look at the S&P low in 2022, its low close was 1% over the 3-year average, and then you shot up. In January 2023, when the 3-year average moved up, your low monthly close in January of 2023 was about 1% over the 3-year average. The lows of those months were below the 3-year average, but they came back and closed barely above the 3-year average. So when you plot an oscillator, you have a low that hit the zero line in a bounce, 2022, a low that hit the zero line, and then the bounce through 2023. That zero line this year is at 43.03. I've got enough dominoes to topple in terms of the momentum metrics of the S&P and the NASDAQ 100, that if you start dropping even a couple percent, I can see the smaller dominoes toppling, the next bigger, et cetera, and the whole cascade begin. And the whole thing gets blown at the 4,300 zone in the S&P. That's the final sell.
Where does the dollar come into all this? Where's that domino?
The dollar's relationship to gold has been, over the last couple of years, a pretty good inverse relationship when you look at the sharp swings in the dollar. But if you go back to 2015 bear low in gold, December, it's doubled. You go back to the 2015 high close in the dollar index, it was trading at 97 area. We're 103. We're up 6%. Gold has doubled. Not a very good correlation. So long term, I'm not sure the correlation is good. Pardon me, tickle in my throat. But there are some technicals on the dollar right now that do suggest that this recent drop we're getting, we dropped a point or so off the recent high. You get back down around the 100 level again. We're 103. I'll start to topple some big dominoes. And the dollar could really drop sharply at that point. So it could become a good wind at the back of gold very easily. Wouldn't take but a 3% drop in the dollar right now to really start to get it going on the downside.
Okay. But it is part of the dominoes that you mentioned that are sort of...
It could be. Yes, it could be. It's not as, I don't think it's as tight right now to gold inversely as the stock market is. I think the stock market is more perfectly inverse to gold, especially since mid-December, when you can basically, the charts are totally opposite. Yeah. And the same is true with T-bonds. So what it says to me is that large portfolio managers out there who've had to be in the stock market because they're competing with their peers, and even if they don't, if they're suspicious, they've been around 10, 20 years, let's say, and they've learned enough lessons to be suspicious about this very narrow advance in the stock market, they still have to be there. Because if they're not, they're being beat badly. Percent gain month over month versus fear. So they have, but if you shake them a little bit and give them the least bit of excuse to say, time to pull out, time to move 5% of my holdings out of stocks and move them to somewhere else, I think they're going to T-bonds and gold. I think they'll respond in that way.
Well, it's been kind of proven too with what you look at some of the 13F filings on the billionaire. Well, I shouldn't do air quotes because they are billionaires. So the billionaire traders or investors, you do Stanley Druckenmiller, Ray Dalio,
correct.
They're all buying these gold companies, or they were all buying them in Q4. I'd be interested to see what happened in Q1, because I'm also reminded of the bloodbath that a few of them are relaxing in right now, specifically Newmont after the painful earnings report, right? And you had sent out a letter on it some 2 or 3 weeks ago, I believe, that also included, I believe, Barrick and Newmont. You looked at both of them. Has your opinion on big gold changed since that report fundamentally?
No, they look like suddenly they could be really the bottom leaders. But got to remember, if you're a major portfolio manager, you don't go out and buy junior miners.
Right.
A stock selling for $2, yeah, it might go to 10 and make a lot more than you would if you bought Newmont or Barrick. But recently, Druckenmiller, just recently, I'm talking 2 weeks ago, he dumped a lot of tech stocks. This was a headline event, NVIDIA and some others, some of the seven so-called, and went into Newmont and Barrick. So only a few weeks ago, he went heavy. Now, I also understand he was also heavy in bullion equivalents like GLD. So he's made a big move, and just recently too, as I understand, especially in the two big miners. And I also heard recently there's some other large asset managers who've also begun that shift. And so when you see Druckenmiller and a few others do it, and you're running an asset, a fund, and you get a little bit shaky about the stock market because you've doubted it anyway, even though you had to be there, and you start to move even 5% of your money out of stocks and move it into something else that's behaving well and doesn't look like it's overvalued, what are you looking at? Well, gold is steady as a rock, despite all the bears. I mean, if you bought gold in 2015, yeah, you're bored to death for the last 3 or 4 years, but basically it's hanging in there, right? Okay. So it's been steady. But the miners have not. Well, then you look at the major miners and you say, well, are they going to zero? No. Gold's not going to zero. It's not even dropping. Therefore, something's wrong here. What's wrong? Either gold is wrong or the miners are wrong. And we argue technically that we think that the miners could turn in a more ballistic manner than we've seen in quite a while. Something more like the summer of 2020 turn up in the miners, which was enormous percent-wise. I think we're sitting at maybe that potential point where even if GDX, for example, which is trading 25, 26 area, if it doubled, it'd be back to its highs and a little higher. Gold would have to go to 4,000. Okay, so we suspect if gold emerges over that 2,100 again, and we've got some trigger levels up there, by the way. You don't even have to go back to 2,150. We've got some trigger numbers on 100-week momentum that say you better not see gold back over 2,100 again because you're going to lift off. There's a structure there that you don't see on price. If you see that, I'll bet you the miners are screaming. They're not coming out of the hole crawling. They're coming out like look at a TLT chart and you'll see what I mean. It's a long-term ETF, government bond ETF. Go back to last summer's collapse and then the upturn since.
Are you positioned accordingly? Do you have any exposure to miners in your portfolio?
We run once a month a SIFT report of the miners. But of course, we're going to miss some because there's so many miners out there. But we sift through all the components of GDX, for example. And it has some small miners in it. $1, $2 miners. And what we do is we plot them in relationship to their spread relationship to GDX. So in other words, how is this miner doing on a relative performance basis versus the broad gold miner sector using GDX or whatever? And we plot that as a chart. And you'll see some of these miners, while GDX has been going down, their spread has been going up, meaning they've been outperforming GDX. And there's two ways they could have done that. One is they actually went up in price while GDX went down, which is would be highly unusual, or they're holding steady, or they're going down less than GDX. So they're a better place to be than the broad gold miner sector. These relationships change. So in any given sector, in any given market over a period of time, you're going to have certain stocks, maybe 25% of them, that are beating the sector, maybe 25% that are vastly underperforming, maybe 50% that are matching the sector. This is true with any sector, tech stocks, healthcare, it doesn't matter. It's true with the gold miners. So we're constantly sifting every month through the relative performance of the mining stocks in their relationship to the sector. And quite often these trends, when they emerge, will last a couple of years. So even if, let's say, you have a 10-year bull market in gold from 2015 to 25, let's say, during that 10-year period, you might find that Newmont, for example, beat the pants off of GDX up through to about 2021. I think it was even 2022. And then suddenly it vastly underperformed. So they rotate in terms of, is it a better place to be than just owning GDX, for example? So we constantly sift through the sector looking for categorizing the outperformers, the underperformers. So that, our subscribers have, if they want to do so, they can select certain miners as opposed to bagging the whole sector,
Well, what about you? I mean, is that something you can talk about personally as to, are you focusing mostly on physical for yourself? What makes more sense for you personally?
Right now, physical, like SLV and GLD, but especially SLV calls. So like at the money, 6 months out type of thing is what we'd be looking at. But there is a point at which when these spread relationships change, favoring silver over gold, which, by the way, won't take a lot of upticks in that spread to break it out. You don't have to go back to the highs of 2020 or something like that on the spread relationship. You'll see a break. It's a technically definable trend. And it has been in a downtrend. Yes, it's been underperforming gold. Same with the miners. But there's a point at which when they upturn a bit versus gold, they break out over these structures, in which case then it's time to shift more out of gold and out of bullion related and more into the miners, and especially at that point, maybe silver miners. Right now, that's not the case, but I think it could be very close. Unless you really believe that the miners are just going to keep going down to zero and gold's not, So you use a little bit of logic there. What's theoretical zero for the gold miners? I suggest maybe we're about there.
Some of them are below zero. You look at some of the lottery tickets that I'm exposed to. They're trading at negative enterprise value, which means they have more current assets on the balance sheet than what their market cap is.
Yeah, I know.
Well, that makes it challenging though, because the stock price matters for them because that's their money, right? That's how they raise capital. So where does that leave my lottery tickets, the explorers and the developers? When do they leave?
It's a matter of timing. It's a matter of emotion. We know there's a lot of emotion here. And there's times when markets are driven by excessive emotion one way and excessive emotion the other. I would say right now, what you're seeing in NVIDIA, you're seeing in reverse in the gold miners right now. Probably worse than it's ever been for the gold miners, especially in the relationship to gold or in their relationship to the S&P 500. They're off the page. Now, you think they're going to zero, fine, then step aside. But if you think, no, how come gold hasn't collapsed and yet the miners have, and yet they've got, what do they have under the ground? They have gold. Oh, they have silver. Oh, they have real stuff. And yet it's not sufficiently priced in the price of the stock. What does that tell you? It tells you there's emotion at play here. Probably some of the emotion is people buying stocks are so fixated on the Magnificent Two now, however many, the seven are gone. We're down to 3 or 4 or 2, Apple is laying on the chopping block right now, as far as we're concerned, technically speaking. It was one of the leaders. Microsoft didn't looking too good either, technically, from our point of view. So at some point, the excess of emotion one way will snap and likely see a void below, because the void below reflects the emotion that drove you up here. And similarly on the miners, there's probably a void of halfway between where we are now and the high of 2020 on the miners. Is probably an emotional void, fully fundamentally unjustified. And so you could gain that back pretty quickly once you trigger the technicals, and they're not far away.
You're mentioning the emotions that are driving some of the stocks, but you also send out these crypto charts and reports through your newsletter. Although I don't pay attention to crypto, as my limited bandwidth wouldn't allow, my loving wife would also wouldn't allow it. I'm only allowed one gamble at a time, and the juniors are my gamble right now. But I know you don't. I know you paid attention to what's happening there. Do you think gold and silver would be higher had it not been for the invention of crypto and how that's been influencing the market?
It's possible. We've followed Bitcoin futures since they began. That was December 2017, and at that point, they were pushing near an all-time high. They went up a little bit more once the futures commenced trading, late 2017. And at that point, I forgot what price they were, but we said they were going to 5,000, which was a major collapse. So in fact, they went to 3,500, Bitcoin. And then we called the next upturn when it got back over 5,000, and we didn't turn bearish. They hit 70,000 late 2021, 2022. Coming off the 2022 highs in the mid 50,000s, we turned long-term bearish. We turned bullish again at 30,000. Right now, they're pushing in the 60s, so they're looking good. The question is, how much do they drain those who are seeking an alternative money unit to the fiat dollar or to the fiat euro, whatever country they're in, and they're buying cryptos? To what extent is that driving them? In other words, are they rebelling against the fiat currency? Some of them are, probably, the more intellectual buyers. Some of them are just doing it because it's going up and they're making money. It's a hot game. So, those are somewhat less than trustworthy buyers in terms of their sustainability as being buyers. If it turns down, they'll run like hell. The question is, for the gold investor, is crypto really going to be an alternative place to hide and put your money in the longer term? Or is Bitcoin, et cetera, more vulnerable to government attack? because it's accessible to the government through their various means. Now, we know that they've screamed about the illegal use of crypto, and money laundering and all these nonsense things that they want to assign, to the behavior of Bitcoin. And now they're concerned about, it's excessive. There's a study going on, the government's running in the energy department, about excessive use of energy in mining Bitcoin. Whoa, whereas they're looking for any excuse to come down on crypto. And, I'm going to suggest that if you own it, they may come down on it at some point. I suggest why. Because a central bank policy requires that they control the money unit. Well, if the public is starting to use a different money unit that is not controlled by the government, then that takes the government's control over the money unit, monetary policy, quote unquote. It lessens the potency of the government control. So they could raise or lower rates, increase the money supply, et cetera, and it threatens their power to control the money. Right. In which case they have a built-in excuse to crack down on crypto. And which is easier to crack down on? Bullion that can be hidden from their view, and et cetera, or crypto. So ultimately, I think that in the longer run of this particular historic event that I think we're facing, which I think will become evident in 2024, 2025 in all markets, that gold will again beat Bitcoin. The spread relationship between Bitcoin and gold has changed, just like the chart of Bitcoin has changed. Back in 2022, we said, okay, Bitcoin's outperformance to gold is over. Gold is now outperforming Bitcoin. Okay, that was in the 50,000s. We dropped under 30. Okay, gold went up to 2,000 and held there. So it did outperform Bitcoin in terms of a place to be. Lately, we've had gold stall and Bitcoin explode. So Bitcoin's again outperforming. But in the longer term, think about that issue. Fundamental issue.
This channel is called Resource Talks, and it selfishly represents what I'm interested in. And right now that's gold, silver, copper, uranium, but with a heavy focus on the explorers and developers. I interview 4, 5, 6 CEOs every week. And YouTube gives you pretty good analytics of what the channel is doing. So this channel specifically, I know you like numbers, it gets give or take 3 million impressions per month, mostly coming from men. Obviously, only about 6% or so are from women, so shout out to them. But the majority of people who watch these videos or who these videos get shown to are above 45 years of age. Something like 65 or 70% are 45 years or older, with virtually zero interest. Actually, it was, I looked at it last night, was specifically like 1.6% interest from the 18 to 24 years old group, right? And I recently watched the crypto interview channel of the same size go through their numbers as well. Not only did they have many more impressions, but the age brackets were pretty much inverse, with like almost 80% was between 18 and 35 years of age, something along those lines. And I've been talking to a lot of people about how that might be interesting, how that might influence the market, but it sounds like this should matter. And a lot of these crypto guys see, again, crypto or Bitcoin more in particular as the digital gold, as you mentioned. So why would they even bother with gold, right? You understand that, but are they going to understand it? So, I mean, I don't even know where to take it from here, but that's sort of a couple of interesting numbers that I pulled up.
Yeah, well, Bitcoin's move is very speculative the way it moves. It doesn't move thoughtfully, it moves emotionally. You could just look at the price chart. Okay. And sometimes when you get a nice move from 30 to 40,000, for example, that's a huge percent gain. And so you caught it, let's say. You tell your friend, oh boy, I'm gonna get into that too. Suddenly you're 50. He tells his friend. It's a contagion. It's an emotional contagion. But there's a point at which finally you might run out of buyers to some extent. And you get a wobble from, let's say we go back to 70,000 and somebody says, okay, I'm going to check out here. They're back to 45,000 or something. The people who bought high get, it's too volatile. And therefore it creates emotional instability from time to time. Gold is far less volatile. And so, like you said, the age categories, and plus the wisdom underlying gold probably is more embedded in the mind of people who are older than the younger people. Okay. And also remember, those younger people are people buying NVIDIA too. Okay. Yeah. So it's sort of the same crowd. Now, I'm not saying if you break tech and the stock market goes down, the Bitcoin's going to do the same. I'm not sure that relationship has to always be similar or inverse. It has been both, by the way, where Bitcoin looks like the stock market suddenly doesn't look like the stock market. So I don't think you can make a link there. Lately, it looks like it's behaving like NVIDIA, I still think the threat is that as a crisis develops, and I think we're headed for an economic, political, monetary crisis of proportions we've not seen. Everybody knows there's debt. It's never before been seen at this level, especially in the US. There's got to be an outcome to it, and it's not going to be pleasant. Okay. A lot of things are going to get hurt really badly. Another way to look at it is this. There's a boom bust cycle in monetary policy that goes on all the time. Go back to when the Fed commenced, okay? In the 1920s, they pumped the money supply up pretty aggressively. I think it was 7.5% a year, okay? Then we had a bust till 1932, okay? You go back and look at the various bull market peaks we've seen in the last 20, 30 years, for example, the 2000 top. The Fed had been raising rates up through May of 2000, just like they've done last year or so. And then they ceased in May of 2000. Well, the market peaked in August of 2000, S&P 500, that is. January of 2001, the Fed cut rates. S&P started to collapse. Okay, so right now, what have you got? This fever anticipation of the Fed's going to ultimately have to cut rates. That's going to be good. No, it isn't. 2007, October, the very high. They had cut rates in mid-September, 4 or 5 weeks before the top tick in the S&P in October 2007, 0.5% cut. They cut all the way down, the market collapsed all the way down. So we're at that same point again, I think, where the anticipation of the rate cut in monetary policy, yeah, it's going to happen, but it's not going to help the stock market. It never has in the past. They shift policy to soft. It's too late. The problem is this time, the bubble is so much bigger than the prior monetary bubbles that helped drive the stock market up. We sat Fed funds rate effectively at zero for like a decade. There was an uptick briefly and back down to effectively zero. Well, that's like investors being given a shot in the arm, hallucinogenic deception. And the cost of money is one of the major decisions in your life whenever you make a financial decision, whether you're buying a home, building a factory, adding employees, et cetera, et cetera. The cost of money is a major factor. Well, if the cost of money is effectively free, or lower than it's been for the prior 3/4 of a century, look at a Fed funds rate chart, you'll see it, then you make all kinds of decisions based on an illusory factor. And they compound over the years. Talking about a dozen-year bull market as opposed to the prior bull markets that we talked about that were 3 or 4 years. And were only doubles or triples. This was 7-fold in the S&P, 16-fold in NASDAQ 100, now a little bit more actually, okay? And it lasted longer. So the delusion, the false mistakes made by companies, state governments, municipal governments, families, are so compounded that when it starts to come apart and they rip the bandage off, which has already been done, think of the real world consequences that will occur that cause pain. Pain causes political emotion. And we know we're coming up for an election that no matter which way it turns out, the outcome is not going to be copacetic. And I don't want to use the word violent, but University of Virginia Department of Politics, I think it was last October, issued a poll where they interviewed Democrats, interviewed Republicans, asked the same sort of questions. If the other party wins power, do you think secession is justified? And it was amazing that about 30% on each side said, yeah. Okay. Question. If the other side wins, is democracy over? Yeah. Okay. If the other side wins, is violence justified? And it was about as high as the number who wanted secession. Talking 30, 40% of the population on one side or the other thinks if the other side wins, violence is justified. Whoa. Is this factored into the markets today? Okay. That's an underlying variable that is built into this. If we start to see economic pain when the stock market comes down and the data points start to change, what's going to be the outcome emotionally, family-wise? Remember 2009, how painful it was for the average family? The Fed went berserk. It created QEs, okay?
But
We have that kind of event coming up, I think.
I'm hopeful that in this case words are cheap, and maybe I'm being naive, but I hope those are just words, and that obviously that doesn't happen. But do you think then ultimately, if that happens or when that happens, that the metrics of for example, this channel that I mostly focuses on mining and metals, do you think they flip? Do you think that's when when the sector starts attracting the younger crowd?
Yep, I
Hmm.
do. I think so. There's already been, as I recall, a year or two ago, that there was already some of that Bitcoin crowd that also liked silver.
Hmm.
On Reddit, there was like a silver.
Yeah, silver squeeze, the
It
eight.
was quite an overlap between the Bitcoin people and that. In other words, there were young people, and
Right.
they post pictures of themselves holding silver bars and things like that. I think that the move, especially over to silver, could be precipitous and quick.
Hmm.
Again, we have to come out of this congestion zone, and I'm arguing that to come out of the congestion zone and gold is the mama. If it comes out of the congestion zone, meaning you go back over 2100 again, the underperforming components, the silver and the miners, will wake up in a way that is, on a percent-wise basis, far stronger than gold. Okay, just like they did in 2020, there was an enormous surge. So watch the mama gold, but I think mama gold is watching the stock market because it knows when that beast breaks sufficiently to cause enough asset managers to doubt. They've already doubted, but they had to be there, remember, okay, because their peers are competing. When they start to shift money out of the stock market and they look at what's undervalued or what's been behaving well, which is gold, it's been stable. You get over 2100, everybody who owns gold is well ahead of the game, even if they bought late. These guys are going to move their money over to that sector. Well, the gold mining sector is so tiny, it would be like a wet bar of soap being grabbed by 5 or 6 different people. Okay, it would go straight up, we argue. And I think what you got to watch there is the movement of assets out of a bloated category into safer and undervalued categories.
Hmm.
And I don't think the shift will be gentle.
Okay, so the miners are watching silver. Silver
And
is
gold.
watching,
Yeah.
but silver is
So,
watching gold. Gold's watching
yeah.
the stock market, and the stock market is watching the elections for an emotional response to it all. So that's basically the domino effect that you did.
I think it's a tight domino effect too.
Hmm.
It didn't used to be, but those who think that if the stock market breaks down, and I'm not looking for a crash at this point, by the way, if we start to break down, let's say in March, start to drop 1% or 2%, and start to trigger some of these numbers that we show in our reports on momentum charts, I don't think you can have a crash event. You may have one later in the year, but the first issue for the stock market is merely to wobble off the highs enough to where people say, well, heck, we're back below the old highs again. And of course, most sectors of the stock market aren't at the 2022 highs. Most sectors, you look at the underlying consumer sectors, for example, retail, consumer staples, even consumer discretionary, which is a risk-on sector. They're not back at the 2022 highs. It's very narrow. But when that starts to wobble back down and doubt starts to come in, especially on people who might be leveraged in certain of these areas, the money shift could become, it doesn't require a lot to move into, for example, the gold miners, to goose that sector up sharply.
What is Platinum watching then in that case? Platinum watching any of all that?
We run a monthly report called the Commodity Report, and we include platinum and palladium in that. And frankly, there have been times in the past where platinum has outperformed gold, and a lot of people made the assumption, and I think it's false fundamentally, that it's a monetary metal. It's not. Yes, it's a precious metal. Sometimes it moves with gold. But if you go back over the last 5 or 10 years, it doesn't. It behaves more. If you'll punch up a chart of the Bloomberg Commodity Index, go back to, let's say, 2000. Bloomberg was at a low in the year 2000 in the 60 area. It's now trading around either just below 100. And look at platinum. You'll see there's a pretty decent correlation between platinum and the broad commodity category. The correlation, though, between the broad commodity category and gold is not good. There are times it is. The late 1970s, for example, commodities exploded along with gold. Not as much as gold, but along with it. But if you go back to, let's say, 2015 on the Bloomberg, and look where it was, and look where it was in 2020, it was lower. What had gold done during that time? Doubled. So it wasn't a good correlation. Platinum behaves more like the Bloomberg. So I think it's important that if you're looking at platinum, don't try to confuse it with gold. Yes, it's going to go up with the Bloomberg, and I think the Bloomberg is set for an upturn. In other words, I think the commodity category is ready for another leg up. I think it'll probably be more so in the grains this time as opposed to energy, for example. But I think platinum will turn up with that. It could perform very well. But I don't know that it's a good idea to link it to gold.
Okay. Yeah, fair enough. Does lithium then I suppose falls in that category too? Because I have it on my list here that I wanted to ask you about. I know we're coming up on our time in about 10 minutes or so. So you're reminding me that you track momentum. You don't focus so much on price. What do you make of the long-term momentum in lithium given the volatility in the price over the last, let's say, 4 years? And
Lithium,
then,
you said?
yeah, lithium.
I'm sorry, we haven't run that. I don't have an opinion. I'm sorry.
Okay, yeah, no problem.
But wait, no, excuse me. We did run recently the lithium ETF of those
yeah, I
involved
thought
in
I
the
saw
production.
something.
And that looks like it's been a total wipeout. Okay. It's basically gone back to where it began its massive bull trend. And I'm going to throw out this comment. Yes, there are some technical factors for the lithium producers, refiners, et cetera, the companies involved for an upturn. And no doubt that'll be correlated to an upturn in lithium again. But it's hard for me to imagine going back over the history of markets when a market has a move like lithium had and a total collapse, not a 50% pullback, but a near total wipeout of what it had done before. It's rare for it to go back to its highs again. So I could see a huge percent upturn in lithium and the miners, but I'm suspicious that the upturn won't get you back to the highs we saw, a couple of years ago. Or whatever, it's so I'm a little suspicious. No, I think they could turn up from here. There are factors that are ready to turn up, the momentum factors that suggest that it's over and you could turn up. But the question is, will it go back to its highs? And I'm a big question mark on that.
Well, I'm sure the listeners and the viewers are going to appreciate the salt that you're putting in their wounds here, but they got to deal with it, I suppose. What have we done? Precious metals. We've done a little bit of base metals with, a correlation to base metals with platinum. And now even battery metals. I suppose I'd be eaten alive though if I don't ask you about energy, more specifically the uranium equities. I mean, we all know that uranium is going to $4,000 per gram over the next 1,000 years, but the equities have not been kind to people who take the inevitable long-term move and expect they'll be imminent too. So what's the momentum telling you about uranium stocks?
We got bullish on uranium. Using the almost non-existent futures market in terms of volume is almost non-existent. Back, God, was it 2017? The price was, no, it was years ago anyway. We were under 20. We got bullish because annual momentum, which had been price had been in a downturn, so had annual momentum, but annual momentum broke out of a very clear downtrend and a basing pattern. You couldn't quite see it on the price chart. But a year later, you could see it on price. Nothing has changed our mind about uranium. It's gone a lot higher than we would have expected. But when we measure that annual momentum trend, and there was not just the price, but it measured versus like a 36-month average or a 3-year, and we plot the oscillator, it's holding its uptrend. It's had a couple of pullbacks and it's held it. However, we're at a point now where if you join uranium now, I think you're doing an NVDA-type trade. Okay. You're chasing something. You buy low and sell high, the old saying. Well, sometimes buying high is okay, but I think at this point it's a bit risky in terms of the kind of drop you could have. Is it going to wipe itself out? No. I mean, the world has changed their mind about nuclear. There's no question about it, and that's done. Okay, so uranium has wiped out the green stuff. Okay, in fact, I think Sweden shifted back to it. Whatever, but it looks vulnerable. It's not a place to be getting long. And therefore, the uranium miners, if they've underperformed uranium, might actually be a bit wise in that they haven't gone ballistic.
But I understand where you're coming from. And again, this is sort of, you're basing all this on momentum. but buy high and sell higher is also kind of nice, especially when you have the fundamentals of the entire story supporting a get crazy type of situation. And what uranium has proven consistently over the last couple of cycles is that when you think that things are getting crazy, they get twice as crazy.
Yeah.
You end up
Well,
missing out on a lot of the gains. How do you embed the fundamental
we don't.
uranium with the momentum
I'm
analysis?
sorry, we don't. We do look at the technicals, and when we see something go ballistic like that, that's gone from X to 5X, over a matter of a handful of years, and it has the technical dynamics of a potential top. In other words, if you sneeze much in uranium price, you're going to start breaking some of these structures we're talking about on momentum, which could create voids on the downside, meaning you could get, $10, $20 drop here or there, and then a bounce, and then, et cetera, et cetera. So we don't factor in the fundamentals. And also, it's probably the case in most major tops in markets that you overprice the fundamentals, and the fundamentals still look good at the top. And even after the top, it takes 6 months to a year later, you look back and say, oh, gee, I didn't realize that. Or, oh, it got overpriced. And I think it sometimes is merely the issue of overpriced, not the fundamentals, but you inhaled, exhale too much in relation to what might be you call the fundamental trend. It goes above it, it goes below it. And emotion could be part of that.
Hmm. Well, how does that happen? Like, how do you make sense of that when if the supply demand fundamentals haven't flipped and therefore the investors haven't flipped, but then momentum flips? Like, how does that happen?
Well, we're measuring price in relation to a moving average that is generated by the price action. So rather than looking at a price chart, which is what you're measuring a commodity or a stock in relation to an underlying fiat currency, which is to say you're measuring it against a plastic yardstick, a rubber yardstick, because that yardstick changes in its real value every year. Every decade since 1959, the money supply has almost doubled in the US. So if you bought a stock and 10 years later it's doubled, well, you haven't really made real money. Yeah, the stock market's up. Oh, big deal. But, in real buying power, it hasn't gained that much. So what we do is we try to measure the asset in its relationship to its own dynamics. Meaning, if you have a leisurely market, then its moving averages aren't changing much, right? Because it's going sideways, so its moving averages are going sideways. So when you oscillate it versus its own mean, which is, yes, it is a factor of the money unit helping to cause that moving average, but it's also a factor of the dynamics of that commodity or that asset that cause a change in the moving average. So to some extent, we're taking the money unit and moving it slightly away as being the only yardstick measure that we're using. It's still there, because even when you do your moving average, it's part of the factoring in of how, et cetera. But we allow the dynamics of the commodity or the stock to help tell us its own valuation in relation to that money unit. So we separate to some extent we try to separate a bit away from the decaying value of fiat currencies. And that's what momentum gives us. It gives us a halfway different picture than simply looking at the stupid price chart, which can be so vastly distorted by a money unit. If you're in some South American country and the money supply goes up 500% this year, who cares where the stock market went up 400%? Okay. You get the point. When we run the momentum dynamics of uranium, obviously those moving averages have increased quite sharply. Not so much due to the degradation of the money unit, which has occurred over the last 5 years, let's say, but more due to the factors of underlying value of uranium. So it gives us a different yardstick. And right now it tells us this is not a place to be initiating new long positions. The fundamentals may be fully justified. In fact, if you go back to the beginning of the move, I'm sure the fundamentals weren't justified. Few anticipated at that point what was going to happen over the next 5 years. It's only probably a couple of years into that people began to realize that, my gosh, the world's going back to nuclear.
That's actually kind of reminding me of what you told me about gold and silver at the beginning, because there were a couple of people out there were a couple of fund managers out there saying all these things about uranium, saying where the supply and demand fundamentals will
No,
go,
well,
but nobody was paying attention until it started getting crazy.
yeah, well,
So
that's
the
called
dynamic,
emotion.
yeah.
It's called emotion. Yeah, and it is, and it's also because it was vastly undervalued in
Mhm.
relation to where it probably should have been. Now, the question now is maybe the should have been is somewhere between where we are now and where we were then, that type of thing. So there's an inhale exhale process in any market that may not be fundamentally correlated.
Mm.
Uh, I mean, the dot-com bubble, okay? Back in 2000, when they were screaming, internet's going to change your life. You know what? They were dead right. In fact, they were more right than they imagined. Far more right than they imagined. You'd had dropped 82% from the 2000 high to the 2002 October low, NASDAQ 100.
Mm.
Okay. So were they wrong about the fundamentals? No, of course not. And yet a lot of Bitcoin, not Bitcoin, excuse me, internet related pop-up companies went bankrupt within 6 months. In fact, I knew a couple of people who started them.
Mm.
Started
Yeah,
in late 1999 and they were out of business in 2000. Were they right on the concept? No, they're just wrong on the timing.
that's right.
Okay.
That's an interesting point too. Resource Talks recently interviewed Adrian Day, and he, by the way, said that the internet hadn't changed his productivity, and so I disagree with him there. But
Well, maybe not. Maybe not.
yeah,
It's changed ours because we would have to put out a market letter and mail it to the U.S. Postal System.
true. Yeah.
Okay, now our people get it instantly. So it's changed us.
No, it's a fair point. What else is at this point where you think uranium was a couple of years ago? I know you've been writing about fertilizers, you've been writing about other sectors too, outside of the resource space too. But within the resource space, anything specific that's catching your attention right now?
No, we think that probably, you've bombed out natural gas to the point where it's overdone on the downside. Okay. Let's look at a price chart. Okay. Uh, we thought it might hold in the $2.50 range, and recently they've plunged to the $1.50 range. Okay. Now, back a couple of years ago, coming up off of its low, we got bullish around this above $2, and we said it's going to 9. It took several years, it got to 10.
Hmm.
Once we got up there, we said it's excessive. You could get a pullback. We had no idea. So we said, get out. In other words, risk reward's gone. Okay. Don't be buying here. We had no idea it would collapse back to 2.5 or so. And now ultimately 1.5. We did not know that. We knew it would come down. I suspect now, based just simply on fundamentals and even just looking at a price chart, you're just not going to drive it much lower. So from an investment point of view, probably natural gas is a buy.
Hmm.
And we have technicals that'll tell us when you get back up to 2.5 to 3, okay, yeah. You could even double the price and it wouldn't mean much, right? Pretty good gain, $1.50 to 3, okay. But beyond that, it's going to require some technicals. Crude oil, we think, is also poised for an upturn again. If you look at what's happened for the last year or so, you got into the high 60s a couple times, shot up. We projected the rally high would get to 95 or 100. You got to 95 and immediately failed back down. Now we're in the 70s, upper 70s, looking steady. It could regain itself. I strongly suspect that when the Bloomberg turns up again, and I'll give you some numbers. Right now, it's the 96 area. You don't want to, if you in the next quarter, meaning 5 weeks from now, you get the Bloomberg Commodity Index of about 101. You're going to go again upside.
Hmm.
It's reborn. You'll have a whole nother up wave. But I suspect, looking at the components of the commodity complex, that while energy will participate in this, remember, energy led that first move, the move from late 2020 to 2022. Energy beat, for example, many of the other subcomponents of the Bloomberg. It was a leading subsector. I don't think it'll be a leading subsector the next time in terms of percentage gain. We suspect grains will be.
Hmm.
Grains haven't broken out yet, nor has the Bloomberg. So we're sitting on our hands. We wait for the breakouts to occur. But the breakouts aren't based on price, they're based on long-term momentum. And both corn, wheat, and beans have certain momentum structures above them that you can't see on a price chart. It won't take a heck of a lot of upturn in price to break out over these momentum bases. Probably will be coincident with the Bloomberg. But again, the Bloomberg is like, we're 4 or 5 points below a trigger number that's applicable for next quarter. Specifically, it's 3/4 moving average, which is be around 101 or so. So it won't take a lot of move up in Bloomberg to re-engage it. And I think that energy will participate, but I don't expect it to be the leader in terms of percent dynamics.
What is analysis of the history of the momentum moves in natural gas telling you? Where does it go from here? Because it seems like there's a whole lot of upside.
Yeah, I think there probably is, but we're not near dynamic levels right now. There's points at which natural gas could trigger an upside, but probably you're going to find problems up in the 3 area. So you could almost double. Okay, great. But there's certain resistance levels on momentum you're going to have to go up and bump and acknowledge. Meaning you're going to have to go up there and probably pull back from them. Not necessarily the low lows again, but go up and bump the ceiling on momentum. You can't see it on the price chart so much. And develop that basing pattern a little bit more before you can engage again in any serious way. So it's going to be a bit more laborious, I think, for natural gas and crude oil even to re-engage in a dynamic way. And remember, crude oil went from like supposedly below zero. We marked that low as $10, by the way. There was an expiring contract that actually traded negative back in 2000. But natural gas is sort of at the same comparable level now. It's theoretical zero. Okay. But there's going to be work involved. Whereas in the case of the grains, we think when they break out over the structures we can define on, for example, quarterly momentum, that they're not going to have so much work involved. They're going to have more upside ventilation. So for the next, let's say, if we break the Bloomberg out, which doesn't require but a few percentage points, sort of similar and inverse to the stock market, by the way, then the asset flow will be more in the grains. And I can't tell you why fundamentally, but I could see it technically.
All right, Mike, I can keep talking and coming up with questions, but I've not been respectful of your time. I know you had to go a couple of minutes ago. So what am I, let's leave it here. What am I forgetting to ask you though? What else would you want to talk about next time?
Next time? Well, when would that be? If it's 6 months from now, I think we'll be in the depths of luxury or hell, depending on which market you're in. I don't trust the stock market. I think it's now created a situation that is more painful than it had it continued down from the 2022 highs, instead going up to make the new highs. Again, very marginal. We said get out of the stock market in January 2022 on the NASDAQ and February 2022 on the S&P. If you got out, you missed the entire downside move, so you felt good. And now they're back up because of a handful of stocks that are front-end loaded. They've made marginal new highs by 5%. So you waited 2 years, and now you're 5% ahead of the 2022 high. Again, it's distorted because most indexes aren't there. You could have bought T-bills in early 2022, avoided the entire stock market, and be doing as well as the guy who's went long the stock market and is cheering right now, and he's 5% ahead of the 2022 highs. If you now fall back below those highs, that's probably going to cause some price chartists to get a little concerned about, did that break out? Was it valid or not? That's down around the 4,800 level on the S&P. And by the way, we've got some trigger levels there too that will be engaged. That should drive you down maybe to the lower 4,000s if you get there. But that could be quickly a disappointment. And when that comes unraveled, so much emotion will be connected with that because so much emotion's been built back into it that wasn't there before. The 2022 high wasn't blow-off type high, whereas everybody wasn't cheering. It was generally a broad market high. Now suddenly it's very, very limited. And so the crowd that's cheering is extremely small. When you punch a hole in their balloon, emotion could get pretty terrific.